Tomorrow, Cisco CEO John Chambers will deliver his keynote address at Cisco Live in Las Vegas. Some Cisco employees are already taking early retirement packages, but Gleacher's Brian Marshall thinks that Cisco must reduce its workforce by at least 7%. Let's bring in another analyst for more perspective. Brian Modoff is a managing director at Deutsche Bank Securities. He's been covering telecom for nearly 2 decades. Deutsche recently lowered estimates on Cisco, and Brian joins us now from Austin, Texas. Welcome to Bloomberg West, Brian. First of all, you have Cisco hinting at layoffs. You have Brian Marshall saying the company could lay off as many as 5,000 people. What's your assessment of that?
Well, the company said that they're going to cut $1 billion out of operating expenses over the next year. In order to do that, layoffs are going to be part of that. Now, they're also doing early retirement packages, and they're going to see how many of their employees take those packages before they assess what kinds of layoffs they're going to need to do.
So in your estimation, how many people need to go? Is it as much as 7% of the workforce?
They'll do what's necessary to get that $1 billion. I haven't assigned a specific number, but we do think it's going to be a few thousand employees, at least at a minimum, that are going to lose their jobs.
All right, I want to bring in our editor-at-large, Cory Johnson. He's been taking a look at Cisco's income statement. Cory?
Yeah, when you look at the breakup of the different parts of Cisco's business, what's the one business that you want to see Cisco get rid of?
You know, they shouldn't be in consumer electronics of any kind. So they've got this CS tablet they've been touting. They're in Wi-Fi. And then if you're looking at lower margin, less profitable businesses, the set-top box business, the Scientific Atlanta acquisition they made, also may not make sense. Those are the areas that we think would be areas that would be perhaps good for them to remove from the list. Other areas we think that are important for the company include routing, switching, some of their more advanced technologies, areas like wireless routing. That's the Starn acquisition, the Tandberg acquisition they made, and then their UCS, which we think is a gem of a product line for them on the data center side.
Well, now, what about other businesses that sort of bridge the gap there? I mean, you've got the services business is a big part of Cisco's revenues. The WebEx business sort of falls into consumer, it falls into service, it falls into using the routers. What do you think about that business for Cisco?
I think they look at that as a driver for encouraging people to use more video conferencing and more video collaboration. So I don't necessarily see that as one of the ones that they'll dispose of.
Do you expect that over time that's the kind of thing, though, that they will continue? Because it seems that the sort of fishing expedition, the pouring out of the chum to try to get people on the web seems to be the places where Cisco stretched too far.
Well, no, if you think about it, the Tandberg and Starn acquisitions were actually good acquisitions for the company. They were definitely contributory to the bottom line. Starn certainly contributing to the gross margin line, and they're assets that aren't easy to replicate. So those were smart ones. Some of the other ones they've made, like the Flip Video, really didn't make much sense, and we hope to don't see those repeated again.
Brian, do you think that John Chambers is the right guy to right the ship at Cisco?
I think he knows what he needs to do. I think that if they execute, they streamline the operations, they get their operating expenses under control. The company can still maintain a 25% operating margin if they're able to manage those expenses. Then I think he can still be the right guy for the company. But I think if he's unable to do these things within the next year or so, then you might start to see the chorus of people saying, bring in a new CEO, grow.
Could these job cuts get Chambers out of the woods and on the good side of investors again?
I think we need to see more than just job cuts. I think you need to see execution. You need to see the company do well in some of the areas like layer 4 through 7, some of the higher layer network intelligence areas where they've struggled to compete against the likes of Riverbed and Acme Packet and F5. I'd like to see them do better in those areas and also continue to do well in data center and in routing. So I think it's more than just layoffs. It's also continued execution in some key areas of growth in the network.
At the heart of this company is the routing business, and they've really let Alcatel Lucent sweep in and take a dominant market share. What's the biggest screw-up you've seen from Cisco in the last 5 years?
Well, I don't agree that they've allowed Alcatel-Lucent to gain dominant share. They're still the dominant vendor in core routing, and they have 45% of the edge router market. But there is more competition there. I think the bigger issue, and the note that we published this morning, is around the switching business. We published a note talking about the margins and the pricing competition they're seeing in switching. I think the challenge they've seen is HP coming in on the campus switching side, which is about 18% of the total revenue, and they've seen pricing there get a lot more competitive, and that switching business has been where the biggest area of concern. It's the one that they identified on their last call as a challenge for them. I think that they definitely need to continue to maintain a dominant share of data center switching where the margins are still more profitable. But I think in the campus side, they definitely need to see better execution.
Brian Modoff of Deutsche Bank Securities, thank you so much for joining us. We will continue to monitor Chambers' turnaround efforts at Cisco, and we will be covering his speech tomorrow.